Welcome to the Deep Dive. Today we're setting sail, really diving into something you've probably seen on, well, every financial chart you've ever looked at. But its true potential, often overlooked. We're talking about moving averages.
That's right. They seem simple, don't they? Just these lines smoothing out the price data.
Exactly. But, the material we've been digging into suggests they can be incredibly powerful. Not just basic trend followers, but more like a compass, really, for navigating the market's hidden rhythms.
Yeah, acting as dynamic support and resistance, which is fascinating in itself.
And even surprisingly, offering some predictive insights.
Absolutely. When you understand them properly, moving averages, they really move beyond just being lagging indicators. They can become guides, helping you see the market's pulse, maybe anticipate turning points.
And potentially project future price behavior, or even timing, especially within those cyclical frameworks we'll discuss.
That's the goal. Our mission here in this deep dive is to unlock that power for you.
We're going to peel back the layers, look at the fundamental uses, sure, but also dive into some advanced variations.
Variations designed to tackle their inherent limitations.
Right, and crucially, understanding their role as detectors, maybe even reflectors, of underlying market cycles. It's all based on the material we've explored.
It really is about shifting your perspective, moving from just seeing a line on a chart to, well, understanding the information that line is trying to convey about the market's inner workings.
Okay, and just before we really get into the nuts and bolts, if you're finding these deep dives useful, if they're offering valuable insights, please take just a second right now to like, share, and subscribe. It genuinely helps us keep bringing these explorations to you.
Your support means a lot.
Okay, so let's start right at the beginning. Fundamentally, what is a moving average? And why are they such a foundational concept in technical analysis anyway?
Well, at its absolute core, a moving average is just a mathematical tool. Its job is to smooth out price data over a specific period. Think of it like taking a choppy sea, lots of noise, and turning it into a gentler, more visible swell.
Okay, so it cuts through the noise.
Exactly. Markets generate a ton of short-term price fluctuations, right? Minute to minute, day to day, that's the noise. A moving average acts as a filter for that noise. It makes it easier to actually see the underlying trend or pattern that might be developing.
So it helps you see the bigger picture, or at least a clearer picture of the recent past.
Yeah.
Smoothed out version.
Precisely. It simplifies that complex mess of price bars into just one single continuous line, and that line represents the average price over whatever window you've chosen. The simplest form, the one most people encounter first, is the simple moving average, the SMA.
Right, the SMA. And how's that calculated? If I'm looking at, say, a 20-day SMA, what's actually happening technically?
The calculation for the SMA is very straightforward. For any given point, let's say today, the value of that 20-day SMA is just the sum of the closing prices for the last 20 trading days. Add them all up.
And divide by 20.
And divide by 20, yep. Then tomorrow, that window moves forward one day. You drop the oldest price from the calculation, the one from 21 days ago, and you add in today's closing price. Recalculate the average.
Ah, okay, so it's constantly updating, dropping the oldest, adding the newest. That's why it's moving.
That's exactly why it's called a moving average. It slides along with the price data.
Got it. Simple average, constantly updated. Now, while that sounds pretty basic, the material we looked at really emphasizes that MAs serve much more significant purposes than just drawing a smooth line. What are these key functions?
Yeah, the sources definitely highlight several critical uses, things that go way beyond just simple trend spotting. Firstly, and this is one of the most practical things you see on a chart, they act as dynamic levels of support and resistance.
Dynamic, meaning they change.
Exactly. As the price moves, the moving average moves with it. And very often, it serves as a level where price tends to pause or reverse or even accelerate if it breaks through decisively.
Dynamic support and resistance.
Yeah.
That's a powerful idea.
Yeah.
Because they aren't fixed lines you just draw once, right? They're constantly adapting to the market's ebb and flow.
Precisely. Price is interacting with these moving lines in real time. That's the first major use. Secondly, and this is where it gets really interesting, when you start to align MAs with the market's own inherent cycles, they can offer surprisingly potent predictive capabilities.
Predictive. Okay, now that sounds like more than just averaging the past. How does that work?
Well, it's not about predicting exact prices, not like a crystal ball. It's more about potentially projecting areas where price might move, or maybe even giving you insights into the timing of potential turns within a market cycle.
Timing insights. Interesting. And how do they achieve that? Is it linked to the noise filtering?
It's deeply linked to their third main purpose, which is filtering market noise. By smoothing the price data, MAs make it much, much easier to identify and observe those important underlying market cycles that often drive price movements. Once you've spotted a potential cyclical rhythm in the market, an MA, especially one configured right, helps you see the average behavior within that cycle. And you can understand how the current price is behaving relative to that cycle's sort of average position.
Okay, let me see if I've got this. They strip away the noise, making cycles easier to see. Then, by relating the current price action to the MA, which reflects that cycle's average, you gain some predictive insight, maybe into timing or potential price swings.
That's the connection, yes. The MA acts as a kind of anchor or midpoint for the cycle's oscillation. And this is a big but, there's a significant challenge with traditional MAs like the SMA. It's something the sources highlight again and again, their inherent lagging nature.
The lag. Because they use historical data.
Exactly. They are calculated using past prices, so they will always trail behind the current price action. It's unavoidable with simple averaging. A 20-day SMA, for example, typically lags the actual price movement by roughly half its period. So about 10 days in that case.
10 days. So by the time the SMA actually turns up or down to signal a change,
the market move might already be well underway, or even over.
Right. That seems like a major drawback.
It absolutely can be, especially in fast-moving markets or volatile conditions. It can cause delayed signals, missed opportunities. And this fundamental limitation, this lag, is really the driving force behind why people developed more advanced moving average techniques. And crucially, why there's such an emphasis on combining MAs with cycle analysis methods specifically designed to try and overcome this lag and make MAs more timely, more effective tools.
Okay, the lag makes perfect sense. You're averaging the past, so you're always looking backward a bit. So, if lag is the main hurdle, how did analysts and developers try to create moving averages that are, well, more responsive? Let's explore those different types mentioned in the sources. What's out there beyond the basic SMA, and how do they aim to cut down this delay?
Right. Well, let's quickly revisit the simple moving average just to nail down its core characteristic. Its defining feature is that equal weighting. Every single price point within that chosen period, whether it's day 1 or day 50 in a 50-day SMA, gets the exact same importance in the calculation.
Okay, equal weight, simple but slow.
Simple but slow. That simplicity is why it lags so much. A price from, nearly 2 months ago has just as much influence as yesterday's price in a 50-day SMA. It's robust for very long-term trend analysis because it smooths out a lot of noise, but yeah, it's definitely slow to react to changes.
Got it. Equal weighting equals high lag. So what was the next step in the evolution to speed things up?
The next really common one, and a major step towards reducing that lag, is the exponential moving average, or EMA.
EMA. I've seen that one a lot too. How's it different?
The EMA uses a smoothing factor in its calculation. The key thing is this factor gives significantly more weight to the most recent prices. Instead of treating all the data points equally like the SMA, it discounts the older data points exponentially. The further back in time, the less influence it has.
So recent price changes have a much bigger impact on where the EMA line is drawn today.
Precisely. That makes the EMA much more responsive to current price movements compared to an SMA of the same period length.
Okay, so its strength is that faster response. Better for shorter term moves, maybe?
Potentially, yes. It's often favored for strategies like swing trading, where reacting more quickly to shifts in momentum is important. But, and it's important to remember this, it still lags. It's just less lagging than the SMA.
It's faster, but not instantaneous.
Not at all. And that increased sensitivity, that quicker reaction, can sometimes be a downside too. In choppy sideways markets where the price is just bouncing around without a clear trend, a more sensitive EMA can generate more false signals, more whipsaws.
Okay, EMA is faster, gives more weight to recent prices, but still lags somewhat and can be noisy in choppy conditions.
Yeah.
This brings us to those advanced moving averages mentioned in the material, the ones specifically engineered to tackle the lag problem head-on. What are some examples?
Right. These advanced types use more sophisticated math, really. First up, you have the double exponential moving average, or DEMA.
Double EMA. Does it just average 2 EMAs?
Despite the name, no, it's not quite that simple. The calculation is a bit more involved. It combines 2 EMAs in a specific formula, but the whole point is to try and reduce the lag that's inherent in even a single EMA. Conceptually, you could maybe think of it like it tries to project the current value by taking an EMA of the price, then taking an EMA of the EMA, and then combining them in a clever way that attempts to cancel out some of the delay introduced by the smoothing process itself.
Interesting. So it's using the characteristics of the smooth data itself to try and anticipate and offset the smoothing delay.
That's a decent way to think about it intuitively, yeah, without getting lost in the exact formula. The result is a moving average that has significantly less lag than a standard EMA or SMA. This makes it potentially much better for tracking fast-moving stocks or maybe for shorter time frames where speed is really critical.
Less lag, faster reaction.
Okay.
And I think the material mentioned a triple exponential moving average too. TEMA, does that just take it even further?
Yes, exactly. The TEMA applies a similar concept but involves a third EMA calculation within its formula. The goal is identical: to minimize that inherent lag even more, enhancing responsiveness to an even greater degree, while still, attempting to keep the line relatively smooth. Its strength is its extreme responsiveness to price changes.
DEMA and TEMA sound like they're really pushing the envelope on speed. Are there other approaches to tackling lag or just improving MA performance in general?
Absolutely. The sources also discussed volatility-adjusted moving averages. These take a completely different, adaptive approach.
Adaptive? How so?
Instead of having a fixed period, like always being a 20-day or a 50-day average, these MAs dynamically adjust their calculation period based on the market's current volatility.
They change their own length. How does that help?
Well, think about it. When the market suddenly becomes highly volatile, prices are making big, fast swings up and down. The MA automatically shortens its calculation period. Using fewer data points in its average makes it much quicker to react to those large, sudden price moves.
Okay, faster reaction when things get wild.
Right. And conversely, when volatility is low, the market is quiet. Prices are moving in a tight, narrow range. The MA automatically lengthens its calculation period. Using more data points during calm periods helps to smooth out those small, maybe insignificant fluctuations. It reduces the chance of getting false signals, those whipsaws, that a very fast fixed period MA might generate in quiet times.
That's quite clever. It adapts its own sensitivity based on the market's temperament.
It really is. It adds a layer of robustness because its responsiveness isn't fixed. It varies with the market conditions. Makes sense, right?
It does. What else was mentioned?
Then there's the whole moving average, the HMA, developed by Alan Hull. This one uses a clever combination of weighted moving averages internally in its calculation. Hull's goal was really specific: create an MA that not only significantly reduced lag, but also maintained a really smooth line. Avoid that choppy look you sometimes get with very fast MAs. It emphasizes recent prices, but does so in a way that tries to minimize those annoying whipsaws while staying very responsive.
So the HMA is aiming for that sweet spot. Responsive, but also smooth. Trying to get the best of both worlds.
That's the idea. It's a balance many traders find appealing.
Okay, lots of ways to reduce lag.
Yeah.
And there's one more thing. Regardless of the MA type, the sources mentioned adding envelopes.
Yes, adding envelopes for volatility around the moving average itself.
Like Bollinger Bands. Is that an example?
Exactly. Bollinger Bands are probably the most common example of this concept. These are basically upper and lower lines plotted a certain number of standard deviations away from the moving average line in the middle. And the key thing is the distance of these bands from the MA expands and contracts with market volatility.
So the bands get wider when the market is volatile and narrower when it's calm.
Precisely. Wider when it's wild, narrower when it's quiet.
And what do the bands actually tell you visually?
Well, they essentially highlight the typical trading range around that average price. When the price hits the upper band, it might suggest potentially overbought conditions, at least relative to the recent average. Hitting the lower band might suggest potentially oversold conditions.
And breaks outside the bands.
Breaks outside the bands can sometimes signal the start of a significant move, like a potential breakout. So adding these envelopes really enhances the MA's usefulness. It gives you a visual representation of the price range and the volatility around that average line, not just the average itself. Provides context.
That's a fantastic overview. We've gone from the simple SMA to these quite sophisticated adaptive and volatility-aware tools. Now let's dive deeper into that powerful application you mentioned right at the start, using moving averages as dynamic support and resistance. How does this actually work on a chart? What does it look like?
Right. This is where MAs stop being just passive lines and become active participants in the price action, you could say. Unlike those static horizontal support or resistance lines you might draw based on past highs or lows lines that stay put, MAs are constantly moving, constantly recalculating, adapting to the market's latest moves. They effectively function like evolving trend lines. They provide constantly updated levels where price interaction is quite likely to occur.
Okay, so the support or resistance level isn't fixed in stone. It's a moving target that's dictated by the average price itself.
Precisely. And the dynamics are usually quite observable when you watch price action around a relevant MA. Let's take an example. Say a market is in a clear uptrend. Price has moved decisively above a particular moving average. Maybe it's a 50-day MA, something representing an intermediate cycle.
Okay, price is above the MA in an uptrend.
Right. Now, that MA can start acting as a support level. What you'll frequently see is, as the price continues generally upward, it'll occasionally pull back. It dips down towards that moving average line, but instead of just slicing right through it, often the price will find support there. It'll bounce off the MA and then continue its upward journey.
Like a floor that moves up with the trend.
Kind of, yeah. And traders watching this might see those pullbacks to the MA as potential low-risk entry points. Opportunities to buy based on the expectation that the MA will hold as support and the primary uptrend will resume.
Makes sense. And I assume in a downtrend, it's the mirror image. The MA acts as resistance.
Exactly the opposite. If a market's in a downtrend and the price has broken clearly below a key moving average, that MA can then switch roles and act as a resistance level. A ceiling, if you like. As the price falls, it might have these occasional little rallies back upward, but when it reaches the MA line from below, it often finds resistance there, fails to break back above it, and then reverses back down, continuing the overall downtrend.
So traders might look for those rallies up to the MA as potential places to sell or initiate short positions.
Exactly. They'd be expecting the MA to cap that upward move and reinforce the existing downtrend.
It's a very practical way to sort of read the trend's health in real time, isn't it? Using the MA as a reference point for potential turning areas within the trend itself.
It really is. It gives structure to the trend.
Now, the material also brought up a related and pretty fascinating concept, measuring moves. Can you unpack that idea for us?
Yeah, measuring moves. This concept often comes up when discussing cyclical analysis and how price swings relate to an average, like an MA. The basic idea is this. When price crosses significantly above a moving average after being below it for a while, say it's coming out of a low point, it rallies, and it crosses above an MA that had previously been acting as resistance.
Okay, a breakout above the MA.
Right. The subsequent upward move after that crossover might potentially mirror the move leading up to the crossover in a specific way.
Mirror it. How so? In size.
The suggestion is that the distance the price travels above the MA after the cross might be similar both in terms of price range and perhaps even the time it takes to the distance and time it took for the price to move from its most recent significant swing low up to the point where it actually crossed the MA.
Whoa. Okay, so you'd identify the low point before the cross, measure the price gain from that low up to the MA crossover point, note the time it took, and then project that same price gain and maybe a similar duration upward from the crossover point as a potential target.
That's the core concept in its simplest form. It's based on this principle of symmetry that you often see in cyclical market movements. Swings on either side of an average can sometimes exhibit these surprising relationships in their magnitude and duration.
Symmetry.
Yeah.
Interesting. So it's not a guarantee, obviously, but a framework.
Not a guarantee at all, no, but it offers a potential framework, a guideline, for anticipating how far a move might extend once it seems to have clearly established itself relative to a key average. It adds another potential layer of analysis.
That's really intriguing. It ties the MA's position directly to potential price targets. And using MAs this way as dynamic support resistance and maybe thinking about these measuring moves, it sounds particularly well suited to certain trading styles.
Absolutely. This whole perspective on moving averages is especially valuable for, say, swing traders.
People holding for days or weeks, capturing those medium-term moves.
Exactly. Swing trading is all about capturing those intermediate-term price swings. So by closely watching how price interacts with these dynamic MA lines, looking for those bounces off support in an uptrend, or those failures at resistance in a downtrend, swing traders can identify potentially optimal entry and exit points that seem aligned with the market's current rhythm or swing.
And it probably helps with risk management, too.
Definitely. It gives you clear reference points for placing stop-loss orders. For example, placing a stop just below the MA that's acting as support in an uptrend. If it breaks, the premise might be wrong. And crucially, it helps them try to capitalize on those cyclical shifts in the market, using the MA interaction as a potential signal that a swing within the cycle might be starting or maybe ending.
So MAs aren't just lagging trend followers, they're active lines on the chart. They help you read the market's immediate intentions and structure within a trend.
That's a great way to put it.
This leads us perfectly into what might be the most critical aspect discussed in all the material. Choosing the right period for your moving average. The sources really hammer this point home. It's not arbitrary. It's intimately connected to market cycles. Why is the period selection so vital, and what's this cycle connection all about?
Selecting the optimal period, the right length for your moving average is, well, it's absolutely fundamental if you want to make it a truly effective tool. Just picking standard numbers, 20 days, 50 days, just because they're common, that's not going to unlock their full potential. The material stresses quite strongly that the most effective MA periods are those that align directly with the natural underlying cycles present in the specific market and time frame you're looking at. Okay, market cycles. What exactly do we mean by cycles in this context? Are we talking long-term economic cycles?
It can encompass various types, but in this context, we're primarily talking about those repetitive wave-like patterns you often see in price movements themselves over various timescales. These cycles are believed to be driven by a whole confluence of underlying forces. It could be the recurring shifts in collective trader psychology, the swing between optimism and pessimism, fear and greed.
The emotional waves.
Exactly. Or it could be linked to shorter-term economic cycles of expansion and contraction, or even seasonal supply and demand patterns that are unique to certain commodities, like agricultural products or energy. These cycles, whatever their cause, represent recurring imbalances that cause prices to ebb and flow, rise and fall, often in somewhat rhythmic pattern.
So they're like the hidden pulse, the underlying rhythm beneath the surface noise of daily price changes.
That's a perfect analogy. They represent a fundamental aspect of market behavior because they highlight that price action is rarely just random noise, and it's rarely just a straight line up or down for long. It frequently moves in these recurring waves. And by understanding and identifying these cyclical forces, you gain a much deeper insight into the market's potential future movements. You can start to align your strategies with its natural rhythm, moving beyond just a simple linear view of trends.
Okay, that makes sense. Cycles are the underlying rhythm. So how does aligning an MA's period with one of these cycles make the MA itself more effective?
Think of it like this. An MA with a period that closely matches the typical length of a dominant cycle in that market. Well, it's essentially calculating the average price specifically for that cycle's duration. By smoothing out the shorter-term noise that's within that cycle, this MA line helps you visualize the midpoint or the average position of that specific cycle's oscillation.
So it becomes a clearer picture of the center of that particular wave.
Exactly. It represents the average value around which that cycle is fluctuating.
So if a market seems to consistently have peaks and troughs roughly every, say, 20 trading days, then a 20-day MA would be particularly relevant for understanding that specific rhythm.
Precisely. A 20-day MA would reflect the average price over that typical 20-day cycle period. But, and here we come back to the lag we discussed earlier, the sources make another critical point. Due to the SMA's inherent lag, which is roughly half its period, right? A 20-day SMA actually lags the true center or midpoint of that 20-day cycle by about 10 days.
Okay. So the line I see on the chart today for the 20-day SMA actually represents the average price from the middle of the cycle about 10 days ago.
That's the conceptual understanding, yes.
Yeah.
To make the MA line up visually with the cycle's current midpoint, you'd technically need to shift the plotted MA line backward on your chart by about half its period, so 10 days in this case. While not all platforms make that easy, the key takeaway is understanding that lag exists and mentally adjusting for it. You need to interpret the MA's current value knowing it reflects the average from slightly in the past relative to the cycle's timing.
Got it. It's not just where the line is, but understanding when that average was relevant in the cycle's progression. Today's 20-day MA value reflects the average price over the last 20 days, centered about 10 days ago.
Exactly. That understanding helps you position the MA correctly within your interpretation of the cycle's current phase. Is price currently above or below where the average was mid-cycle? And then around this cycle-aligned MA, mentally adjusted or shifted, adding those envelopes we talked about, like Bollinger Bands, becomes even more powerful. They can help visualize the typical volatility range within that specific cycle's boundaries.
That's a much more sophisticated way to use MAs. It's not just about the slope anymore. It's relating their position and level to the market's underlying waves.
It really is. It connects the indicator to the market structure.
But this raises a big practical question. How do you actually find these hidden cycles?
Yeah.
How do you determine their typical lengths in the first place? It sounds complicated.
It can be, yeah. This is where more advanced analytical techniques come into play. The sources mention methods like spectral analysis, or perhaps more famously in trading, Hurst Cycle Analysis.
Spectral analysis, Hurst cycles. What do they do?
These are essentially advanced statistical techniques. They take historical price data over a long period and mathematically decompose it, breaking it down into its component frequencies or periodicities.
Like taking a complex sound wave, like music, and finding the individual frequencies, the different musical notes that make it up.
That's a fantastic analogy. Price data is a complex signal, just like sound. These analysis techniques help decompose that signal to find the underlying dominant repeating patterns the market's notes or cycles. There are specialized software tools out there, things like Timing Solution or Sentient Trader are often mentioned in this field, that apply these spectral or Hurst analysis techniques. They analyze the price data and try to pinpoint the average length of the most prominent, statistically significant cycles in that particular market.
So the software might analyze, say, gold prices and tell you, okay, we're seeing a statistically strong cycle that averages around 23 days in lengths.
Exactly. It gives you a data-driven finding, and that finding would then strongly suggest that using a 23-day moving average period, perhaps using a less lagging type like an EMA or DEMA, and understanding its relationship to the cycle phase could be particularly effective for trading gold on that time frame.
So you use these specialized tools to get a scientific, data-driven insight into the market's natural rhythm. And then you choose your MA period to deliberately match that rhythm.
That's the systematic analytical approach. It takes the guesswork out of picking periods. However, the sources also discuss the significance of certain universal periods, those really common MA lengths like 20, 50, 100, and 200 days that you see plastered on charts everywhere.
Yeah. Why are those specific numbers so popular? Is it just because everyone uses them?
Yeah.
The self-fulfilling prophecy?
There might be an element of that, sure. But the sources suggest it's more than just tradition or popularity. These specific periods frequently seem to align with common, almost universal market cycles that are observed across many different instruments and timeframes. And importantly, as explored extensively in the foundational work on cycle analysis by J.M. Hurst, these longer universal periods are often approximate multiples of shorter, more fundamental cycles.
Ah, okay. So it's like those Russian nesting dolls you sometimes hear about in cycle theory. Smaller cycles combine or nest within larger ones.
Exactly. Hurst's research really highlighted how market cycles often exhibit these harmonic relationships. Shorter cycles tend to nest, sometimes quite neatly, into longer ones. And these standard universal MA periods frequently align with those dominant harmonic lengths, the lengths of the larger composite cycles formed by the smaller ones.
That makes sense. So what do these standard periods often correspond to, roughly, based on the material?
Generally speaking, a 20-day MA often corresponds to monthly cycles, thinking in terms of trading days. So it's useful for shorter-term swing trading strategies. A 50-day MA tends to capture more intermediate-term cycles. Still relevant for swing trading, but looking at slightly longer moves, maybe several weeks. A 100-day MA aligns with longer-term cycles still. This is moving more into the realm of position trading, where you might hold positions for weeks or even months.
And the big one, the 200-day.
The 200-day MA is very widely watched, often cited as a broad definer of the really long-term trend. Is the market generally in a secular bull or bear phase?
Right. Price above the 200-day is bullish long-term, below is bearish long-term. That's the common wisdom.
It is the common wisdom. However, the sources we looked at offered a really crucial word of caution regarding the 200-day MA. While it's a popular reference point, they strongly emphasize that the true direction of the long-term trend should primarily be determined based on price action and market structure itself.
Meaning, looking at the pattern of highs and lows.
Exactly. Are you seeing consistently higher highs and higher lows? That defines an uptrend structurally. Lower highs and lower lows. That defines a downtrend structurally. The analysis shouldn't solely rely on whether the price happens to be above or below the 200-day MA line at any given moment. Indicators like the 200-day MA should support or confirm your assessment of a market structure and direction, not dictate it. Price action is king.
That's a really important distinction. Use the MA to illustrate or confirm the trend you've already identified through price structure. Don't just let the MA crossing define the trend for you.
Precisely. Don't let the tail wag the dog, so to speak.
Okay, so we can identify cycle lengths through specific analysis tools, or we can use these universal periods that often relate to common harmonic cycles. But the sources also highlighted the value of optimizing MA periods. What does that involve? Isn't identifying the cycle length enough?
Optimization adds another layer of data-driven precision. It's about fine-tuning. So instead of just picking a period based on theoretical cycle analysis, or just using a standard number like 50, you can use specialized backtesting software platforms, Amibroker is a well-known example, often used for this to run historical tests. You essentially feed the software your trading strategy rules, but you let the MA period be a variable. You tell it to test a range of different MA periods, say from 10 days up to 100 days.
And the software tests how the strategy would have performed historically using each different MA length.
Exactly. It runs the strategy over years of historical data for each potential MA period within your specified range. Then it tells you which specific period, or maybe combination of periods, if your strategy uses more than one MA, would have historically produced the most favorable results, based on whatever metrics you care about: total profit, risk-adjusted return, drawdown, win rate, whatever your criteria are for that specific market and time frame.
So it finds the period that has empirically, historically worked best for the specific instrument and strategy you're trading. It's not just theoretical anymore.
Precisely. It moves beyond a theoretical best fit based on cycles and finds the period that demonstrably aligns best with that market's actual historical behavior and your specific strategy's objectives. This kind of rigorous optimization process is really crucial if you want to develop trading strategies that are not just visually plausible on a chart, but are statistically robust. Strategies that have shown a quantifiable historical edge over time for the specific instrument you intend to apply them to. It builds confidence that your chosen MA period is truly resonating with that market's actual patterns, not just a guess.
Okay, let me try and synthesize this. You can get a good starting point for your MA period by identifying potential cycle links, maybe through analysis software, or by recognizing how price reacts to standard periods related to common cycles. But then you can potentially refine that period choice even further by using backtesting software to optimize it against historical data for your specific market and strategy.
That's the core message, yes. Combining that understanding of the market's natural underlying rhythms derived from cycle analysis or observation with rigorous backtesting and optimization techniques, that allows you to truly tailor your moving averages to the specific characteristics of the market you're trading and the time frame you're focused on. And doing that significantly enhances their power and effectiveness. It's about precision. By taking this kind of systematic, data-driven approach, you build more intelligent trading strategies that are less likely to get chopped up by random market noise, and much better equipped, hopefully, to capture those genuine, sustained moves that align with the market's actual cyclical behavior. It really transforms MA usage from just a simple visual aid into a potentially powerful, highly calibrated analytical tool.
It really is quite remarkable, isn't it? How much depth there is to something that on the surface seems so simple, something that often gets written off as just a basic indicator for beginners.
Absolutely. The journey from just seeing it as a simple calculation to understanding it as a dynamic, cycle-aligned analytical tool. It's a significant leap in understanding.
We've covered so much ground. The various types designed to reduce lag, SMA, EMA, DEMA, TEMA, volatility-adjusted, Hull.
Their crucial role as dynamic support and resistance levels, moving with the price.
And maybe most importantly, this absolutely vital connection to market cycles and how choosing the right period based on those cycles or optimizing for them is key.
It ties it all together.
So as we start to bring this deep dive toward a close, let's try and summarize the key insights we've really uncovered here. Moving averages fundamentally are far more powerful than their simple appearance might suggest.
Definitely. They're not just lagging lines that follow a trend after the fact.
Right. They possess this capability, when used correctly, to actually help reveal underlying market cycles.
They function as dynamic levels of support and resistance, adapting to price action in real time, which is incredibly useful practically.
And perhaps most intriguingly, they could even offer insights into potential future price and time movements, especially when they're properly aligned with those market cycles.
And overcoming that fundamental challenge, the lag, is crucial if you want timely signals from them. Exploring those advanced MAs we talked about, DEMA, TEMA, HMA, can significantly reduce that inherent delay. That makes them more responsive, better suited perhaps for faster moving markets or shorter term trading styles.
But the linchpin seems to be the period selection.
Absolutely. Perhaps the most critical takeaway is that aligning your MA periods with identified market cycles, whether you find those cycles through advanced analytical methods, careful observation, or rigorous optimization processes, that alignment is essential. It's what maximizes their effectiveness and really transforms them into powerful analytical tools that reflect the market's true rhythm.
And important note here, like any single indicator, moving averages are always going to be most powerful when used in confluence with other tools and analysis methods.
Oh, for sure. No single indicator ever tells the whole story of the market. That's a recipe for disaster.
Right. So combining insights from moving averages with your analysis of raw price action, market structure, those highs and lows, volume, maybe other complementary indicators, that helps to mitigate the inherent limitations of any single tool, including MAs. It gives you a more comprehensive, layered view of what the market might be doing.
It's all about building a robust framework for making decisions using multiple, hopefully non-correlated sources of information.
The MA is a potentially vital piece of that puzzle, but its strength really comes from how it fits together with the other pieces.
Well said.
So for you listening right now, probably the best way to truly grasp this potential is to, well, dive in and experiment yourself. Load up your charting platform. Try plotting different MA types on the same chart. Compare a 50-day SMA versus a 50-day EMA, maybe throw a 50-day DEMA or HMA on there too. See how they react differently to price.
And then experiment with different periods. Start with those universal ones, 20, 50, 100, 200 days, and just observe carefully. Watch how price interacts with them. Do they seem to act as dynamic support or resistance levels in the markets you follow?
And crucially, start to think about or look for how aligning those periods with potential market cycles might change the signals you perceive.
Does price seem to respect a particular MA period more consistently over time? Does that suggest a dominant cycle length? Observing that interaction really deepens your understanding of that specific market's behavior.
Now, translating all these insights, cycle analysis, optimization results, observing dynamic MA interactions into actionable trading strategies that try to follow the market's rhythm, that could be a complex and time-consuming process.
It definitely requires effort, testing, and discipline.
And this is really where data-driven solutions, like those developed by specialists mentioned in the sources we explored, can potentially come in. They aim to do much of that heavy lifting for you.
Yeah, utilizing thoroughly back-tested, data-driven solutions can provide a systematic framework for actually leveraging these kinds of insights. It helps move away from discretionary guesswork towards more robust, rule-based trading strategies.
So maybe a final thought for you to mull over as we wrap up this deep dive. How might recognizing the cyclical rhythm that often underlies market price movements, and then using tools like moving averages that are specifically calibrated to those rhythms, how might that fundamentally change the way you approach identifying opportunities and making your trading decisions?
It really shifts your perspective, doesn't it? From just reacting to what feels like random price fluctuations to trying to understand and potentially anticipate the deeper, often repeating patterns and forces that might be driving that price action.
And if you're interested in exploring how data-driven, back-tested solutions can help with this, solutions that leverage cutting-edge algorithms designed specifically to identify and follow the powerful moves often associated with smart money,
while also emphasizing crucial risk management principles, which are absolutely vital for long-term success.
Then, based on insights like the moving average and cycle analysis we've discussed today, we encourage you to visit AccumulationPro.com.
You can discover how a systematic, data-focused approach might help inform more robust and disciplined trading strategies for your own journey.
Thank you so much for joining us for this deep dive into the perhaps unexpected power and cyclical connection of moving averages.
We genuinely hope this exploration helps you see these familiar lines on your charts in a completely new and potentially much more profitable light.